Thanks for joining another episode of Wealthlab Podcast with Scott and Phil. Today we have Nick. All right. So friends, today's episode is talking about the investment markets and specifically the managed discretionary account service that we have put in place. We went through an extensive beauty parade of looking at different asset managers, and Nick was the best, most attractive looking. So congratulations,
Nick was
mate.
the most beautiful. I like it. Yeah.
I feel like I've just won. I've come second in a beauty contest in Monopoly. And look, thank you so much for having me, guys. It's always wonderful to engage with companies like Wealthlab because it's very very rare to see people who are as dedicated and as switched on with their investments and client solutions. It's a good thing. So
for a bit of context, if you're listening to this episode, we have gone through. I mean, I've wanted to build in a mandatory discretionary account service for probably 3 or 4 years within the business, and it's taken us a really, really long time to get everything all organized, all our ducks in the row to prepare it. I know if you're listening to this podcast, I probably sent it to you, and I said it's been taking us so long to do it. So I just thought I'd just record a podcast with Phil and myself, and then Nick, just to explain how the service works, why we're such believers in it, and why I'm really pleased to have Nick on board. So Nick, I'm just going to kick off with a little bit of background on yourself. Bit of business, a bit of background on Haven, and then your thoughts on the managed discretionary service, and we will go from there.
Yeah, that sounds great. No, I appreciate the opportunity for me to tell mine and our story, the Haven Wealth company story. So I've worked in financial services for probably too long, 25 years. My father was a financial planner for 30 years. We found our passion. And our passion is investment and numbers and also helping people. And as a financial advisor, I actually chose to redirect my career within the field of financial services because as much as I loved giving one-on-one advice, I wanted to have an impact on a bigger scale. So I actually had the opportunity starting Haven Wealth, got together with a few like-minded people, and we raised capital and we started a funds management business that was true to label, and we really build things that match our ethos and our approach.
I like it. So when we were looking at different asset consultants to help partner with Wealthlab and build our models, what stood out to us was that commitment to that sort of the ethical side of things, as well as just sort of that passion for focusing on the minute detail, which was excellent. So the way that we sort of view it is that we're at the coalface, so to speak, when it comes to the advice position. And when it comes to the specific picking of assets, it's actually much more effective to partner with someone who will then build those portfolios and then manage them on an ongoing basis. So traditionally, let's say you're in a Host Plus or even you're existing one of our existing clients, which is in a portfolio at the moment, they're actually really difficult to make changes. Yeah. You need to do a new advice document even for one individual stock change or one individual manager change. It's not very flexible. If a manager is underperforming, it's very difficult to remove it and then put another one in. Yeah. So can you just give us a bit of background in terms of how that MDA, Management Discretionary Account Service, works and how your service plugs into that as a part of the anchor point portfolios that we as a group have built? I'll get it right the next time.
You get it. Yeah, keep working.
Yeah. So look, the relationship between the advice company, in this case Wealthlab, and the investment manager or portfolio manager being Haven Wealth, we work hand in glove with you. So it's your job to be to advise on strategy and to advise on risk profile and really get to know your client in and out. And it's our job to build the product. You really can't be, you as the planner or planners can't be the masters of every aspect of that right through to product delivery. And if you did do that, and some try, you bring on implementation risk and a number of different things that it's really a case of working with another party and each party stays in their lane. You're quite right. And this is one of the things that used to frustrate me a lot when I was a planner, that if something was underperforming or needed to be changed, or let's say when there was recently a couple of delistings on the ASX. So if that happens, then you have to rejig things. You'll have to go back to the client and charge them a couple of $1,000s for a ROA or a record of advice or a statement of advice then the client's getting unfairly charged to make a very simple change. And that is the beautiful simplicity of the MDA, is that the investment option is what it is. It's structured in a way that it has a certain amount of exposure to growth assets and defensive assets, and it fits their risk profile. But under the hood, well, much like the super funds like Host Plus and Aussie and Aware, they don't notify clients every time they chop and change a manager or an equity. We work in exactly the same way. So as long as we keep the broad exposure to growth and defensive assets, that we can tweak and refine the things underneath to make sure we get the best performance possible and we stay within risk profile.
So it's that nimbleness and that performance focus is really what we're really pleased on. And it's not necessarily the absolute performance, it's also the ability to manage. If we just see one manager that's underperforming, or we see one asset class that's underperforming, we can, you will be able to make those changes, and then that instantly is across all client portfolios at once.
And importantly with that, so not just we change it, but we work. So in this case, it's us and Wealthlab. We work with you guys, so when your clients ask, or even if they don't ask, you can actually proactively go out and inform your clients that we actually are actively managing these changes. So there is a much greater level of transparency. I find that larger super funds like your Host Plus and Aussies are quite opaque.
Oh, they got no idea. Yeah, no idea. Yeah.
That doesn't just go to the investment options and where money's going and what's going on either. But it's even just the levels of costs and stuff in the fund that it can be really hard to determine by looking at your statement with a traditional super fund what you're actually paying for the underlying management stuff. That transparency and stuff, I think for me is a huge thing with sort of what you do and what we're doing here. Yeah. Sorry, Scott, cut you off. Yeah.
No, I was just saying that I feel maybe we'll ask a question around performance. What's your thoughts on the performance process and how we select managers, and Phil, what have you seen in the past go wrong, and what are your thoughts on why you like the MDA process?
Yeah, geez, good question. Well, there's a whole, there's a lot of stuff that can go wrong. There's a lot of things we've got to manage. I think one of the great things about having someone like Nick come in and we have our investment committees, we sit down, is it's just not you and I sitting there staring at each other in an echo chamber and just telling each other that we're smart. We've got Nick to come in and tell us we're both idiots sometimes, or not really, but we can argue and we get a better, I suppose, a more holistic point of view, and that's part of it. But thinking about things that can go wrong in the past, like fund managers will put a PDS out. They'll tell you that they're going to do certain things, and maybe they don't stick true. Maybe they're not true to label. They don't stick to what they're supposed to be doing. Maybe they are true to label, but what they're doing doesn't work in the current cycle, and those kind of things can happen in a portfolio. So it's nice to have that nimbleness that, or it could be, maybe we've selected a fund manager for a certain reason and he's retired and his replacement rolls in and we don't like the replacement for some reason. There's any number of things that could trigger a change, and having that sort of nimbleness to be able to just flick them and pull someone else in and having external expertise to help make those decisions and stuff, I think is a huge advantage to the MDA sort of process.
And the benefit of us having a relatively small group and having that nimbleness or agility is we can make quick decisions. So I'll give you an example, and I probably can't go into nauseating detail here because I've still got good friendships at these funds, but both the funds I used to work at before, there are changes that should have taken 6 weeks that actually took several years. So larger funds tend to move like molasses in wintertime, whereas we can move a lot quicker with adding or removing different managers and or equities, but we do so with a fairly detailed amount of scrutiny. So then we don't knee jerk.
Yeah, I was about four beers deep with one of the asset managers at maybe one of the biggest funds in the country about a month ago, who was telling me exactly this. And saying, he was complaining about his job. He was like, my job is so annoying. It's just the standard. Any white collar manager who's just like, oh man, the bureaucracy at work is so stifling. It's so frustrating trying to manage all these different counterparties. And I couldn't help myself. I had a bit of sort of, I don't know, like I said, I was probably four beers deep, and I just threw it at him. I was like, well, what about the performance on your clients? Like, what's that performance drag that you're talking about is suffering that opportunity cost, which means the lack of performance they've received today is the opportunity cost of something you could be compounding in the future. And his response was, he was just like, I'm looking for another job. like like that,
Yeah.
like dang. And I mean, look, there's like, we all are, we've all come across that type of someone else, in a Optus, in a Telstra, in a NAB, in a in a Medibank, working these massive conglomerates, and they just hate their role. But this was so unique because I was like, dude, I'm trying to help people here, and you guys are on the TV, you guys are sponsoring the tennis or whatever else, and it's like, I know we've got a better product. I know our investments are more nimble. They give greater clarity. How the hell do we get this out to a wider audience? So that's why we're doing the podcast. But yeah, that's my view on why I like the MDA. But Nick, if I can sort of throw it over to you, can you talk me through the asset selection process you take people through, how you like to manage cost, because cost is a huge element, as well as what we refer to as liquidity and what that means from a client perspective if I was putting my super into this?
Yeah. Yeah. Well, look, liquidity, I'll start with there and I'll work my way back. But liquidity is of the utmost importance because although for most of us, you can't access your super until you're well into your 60s. For those that are getting close to that point, who can start to do different strategies, transition to retirement or need to access their super should something happen to them, they might be totally permanently disabled, etc. You need to make sure that your money is not locked away and it's so inflexible that it's just going to have to sit there and you're going to have to wait. And that waiting time is going to feel like torture because you need it now. And I remember back when I first started as an advisor, and this was around GFC time, there were a lot of people who had money caught up in the ANZ mortgage-backed securities fund. ASIC froze them to stop a big run on them, and I think they're still frozen, some of them. And we're talking,
there's still some out there. Yeah.
So, and there was an ING fund as well, I think, that was in the same boat. So, that liquidity is paramount, and it's not just liquidity for the person to access, but it's also liquidity for us to be able to maneuver in and out of a manager should we need to.
So what do you mean liquidity? So, like, be specific. So, what does it actually mean? Is it water? Is it running down the street? Like, what do we?
Is it wet? And I'm glad you pulled me up there because it is so easy for us to get into talking shorthand and talking industry speak. Liquidity simply just means the ability to put money in or get money out of an asset within, and liquidity would indicate a very short time frame to be able to do that. So, buying a share on the stock exchange, for an example, you should buy it, you'll have it tomorrow, or T+3, I think, or T+2. Whereas there are some managed funds where you put your money in there, it might be fairly illiquid. Let's say it's a private equity fund, it might be locked in there for a year or longer. So if that manager happens to do something really bad, or look at Magellan, for example, where they had a personal crisis that sent the whole fund into a tailspin, we would want to maneuver out of that fund, or at least have the option to. Very quickly.
Again, for the layman, so Magellan is or was probably one of the biggest managed funds used by almost every advice business in the country. They were, an equity manager, so they were buying and selling stocks. They had an internal crisis. The ratings changed, and therefore there was a run on that one manager, and they basically was locked, and the ability to get money out. I think an easier understanding to think of when we think of liquidity is just how many buyers and sellers there is in the market. So, for example, if we think of, and it's actually referred to as an order book. So, for example, let's say, whatever, just let's just say Macquarie Bank is trading at, I know it's trading at more, but let's say it's trading at $100 a share. How many buyers and sellers underneath that and above that are there? So if I wanted to move a lot of money right now, would I be able to actually have buyers at that price? So, for example, if I'm removed to say one of the companies that say there's 2,065 companies listed on the ASX at the moment. If I were to go to say company 1,500, the number of buyers and sellers of that would be way smaller. So if I were to dump a big sell order or buy order, there'd be very few people willing to take that. And the only people that would be willing to do it would be at a much different price than its current. So I would lose on the buy or the sell, depending on how desperate I was to get in or out of the trade. So it's just that liquidity of how many buyers and sellers there are. So if you've got a managed fund that has a 4 week, 6 week, 6 month turnaround, meaning money to get out, you're locked up, you can't get in or out. And that's more of an artificial secondary. That's more of an artificial, that's like the terms of the manager rather than the actual liquidity of it. So the manager will set their own terms. And Nick, that's part of why we use you, so that we are managing those types of managers. For example, we went through with you in a fairly close detail around our fixed income managers. Fixed income managers can be really difficult to get in and out. And the manager that we've added to the Anchor Point portfolio, we're really pleased because we've got T+2. So we sell it today, we can get our funds out within 48 hours because it's listed on the markets, on the stock market, rather than being a privately held off-market fund, which where the majority are. And this gave us a similar type of income to these off-market funds with that ability to get in and out, which is why we have added it to the portfolio.
Yeah, and one of the best examples for majority of Australians would be term deposits. If they've got money sitting in a cash at call account, like an online savings account or something like that, it might be paying a lower rate, but they can take it out tomorrow. They might forfeit some interest in doing so, but they've got access to it. Whereas with term deposits, usually you lock them in for 6 months, 12 months, sometimes longer, and they say you can't break them. But if you do break them, typically there's a penalty for it. But with managed funds, even though it might be a 12-month liquidity window or illiquidity window, you can still probably approach them and ask for the capital, but it's up to their discretion. You signed up.
How bad are you going to get stung for it? Yeah.
Yeah, they've got no obligation to pay it out. So having that level of liquidity is important, but making sure that we use very experienced and reputable investment managers and managed funds because track record is important. Also to make sure that, to your point, Scott, that there is the market depth there is the demand and supply. So when we do buy direct equities or shares, we typically only buy large or medium market capitalization, which is determined based on the size of the actual business. So BHP would be a large cap, and then you get the idea. The small cap funds, which is probably the bottom half of the market of those 2,000 you spoke of, there really isn't the demand. You can go in and buy the shares because there's probably people willing to sell them, but we're talking the 2 or 3 or 4 cent mining exploration shares.
Penny dreadfuls.
Penny dreadfuls, that's right. Yeah. I love that term. Everyone thinks, we just think about the share market game when we're all at school. I'm sure we all had a crack at it. If I buy a 1 cent share and it goes up to 2 cents, I've doubled my money. It doesn't work like that.
You've got to find someone to buy it.
Yeah. So liquidity is important, and the reputation of managers is key.
I want to just take a little bit of a different tack now. We've spoken a bit, I guess, around the portfolio construction and how we think there and what an MDA is and that sort of gear. I'm really curious now, especially given it's probably timely we're having this chat, that the markets have been a little bit up and down over the last couple of weeks. Curious as to your thoughts on what's going on out there and maybe what's coming.
Yeah, well, look, I'm no oracle. I don't have a crystal ball, but I do. These thoughts are mine and mine alone. It's important to say because there are a few things that are going to happen, which I'm fairly certain are going to happen. There will be more data breaches and data security issues. We saw the Microsoft dilemma. Was it last month? We've seen lots of different data breaches and different large organizations getting hacked and personal details getting compromised. That is going to be a big issue. And even talking to our PI, our professional indemnity insurer, he's of the opinion that the companies are going to be getting cyber policies with PI included in it rather than a PI policy with cyber included in it.
Yeah, right.
And
that's interesting. Yeah, okay.
Because data is an asset. It is a massive asset, and I think that's something that there's really some fundamental weaknesses which have been proven in the last couple of weeks, where we have to be very careful and cautious as to what information we put in where. That's one thing. The US election is going to be pretty interesting, to say the least. That is coming up pretty soon. I'm quite glad that Biden stepped aside. I'm glad that he got in, but I just don't think he had anywhere near the chance to win that election. So yeah, I'm not sure what the flow-on effect of that is going to be, but there will be some. because if Trump happens to get in again and he's got a huge amount of support, that is certainly going to ripple through our economy. The Australian economy tends to be quite reactive because we're small, because we're isolated, and we tend to be we're a major exporter with iron ore. It doesn't take much to flow through to the impact our market. But my only suggestion would be, and this is our approach, know what you own and why you own it. And just be aware that the market is where the impatient give money to the patient.
Yep.
So, Nick, let's just wrap this up. I'm just going to keep an eye on the time. If you, so we've created 4 portfolios called Anchor Point 1, 2, 3, and 4. And an anchor point 1 is something that's probably closer to someone who's wanting to not take a lot of risk and wanting to get bank-like returns or a little bit better. Or an anchor point 4 is someone who's willing to go, you know what, I've got a 10-year time frame. My money's in super. I can't access for another 10 years. I want a lot of growth companies that are doing productive stuff, doing interesting things. Over the time frame, over a 10-year time frame, anchor point 4 will outperform anchor point 1. Just because there's a different cash allocation. Cash is a performance drag, but it also adds stability. So if you're looking for something like a short-term saving product, if you've got a house coming up, you buy a house in 18 months' time or 12 months' time, or you're saving something within an 18-month time frame, you and us have built the Anchor Point 1 portfolio for that because it's quite low volatility, up and down. And the Anchor Point 4 is the opposite. So it's going to be a 7 to 10 year time frame. It's going to give you quite a lot of volatility, but over the long term, that will perform best. I just would say, so if we were to wrap it up, what would be your final thoughts on, as a user, why would this product be better than, say, just a generic managed fund portfolio by another advisor, or even the industry funds?
Yeah, look, having a level of connectedness and being able to contact both yourselves and us and your clients, we're more than happy to speak to your clients directly as well. That's a level of contact and exposure that investors typically don't have. I know, and it used to frustrate a lot of members too of the funds that I worked at before. They go, well, who's actually in charge of this thing and who knows what's going on? And I guess it's easy for them to try and play their specific roles, but what they miss is that there are a lot of questions that clients want answered, and there's a lot of fears they need allayed and context they need provided. So we do more than just investments. We do investments, but we also help provide that context and understanding, and I think that gives peace of mind, and that's the key. That's what people want. They know they're going to have risk. They know they're going to expose to the market. But they just need someone there to hold their hand, which is probably you and us, to help them through it. Because the last thing we want is for them to make knee-jerk decisions, because that's where they miss out on those big growth moments, as we've already spoken about previously to this conversation.
The reason why Phil and I really like it is it just gives you that granular detail. You can actually see where you're at. Yeah. The most annoying part, even with, say, for example, a normal managed fund, you've got no idea where the underlying assets really are. And this is just one step closer to understanding what you actually are holding. Phil, thoughts on that?
Yeah, 100%. I was just actually reflecting on what you were talking on a client conversation I had not that long ago. We sat down for an annual review and I popped open the account, popped open all the underlying investments, and we talked through them all. And what he said just really stuck with me. He's like, mate, this is unbelievable that I now know how every part of my portfolio is performing, and I can see this. I could never get that from my existing fund. I didn't know what they were doing. And it was just that level of understanding, context, and clarity, exactly like you're talking about, Nick, helps. If markets are down or things are a bit volatile and stuff's going on in the world, having that being able to sit down with someone and have that context and clarity about what's actually going on at a granular level within that portfolio, I don't know, it was particularly for that client, it was a huge amount of comfort, which does stop those knee-jerk reactions, stops people from doing silly things, which is where you hurt yourself. And, I think a lot of that comfort and clarity is invaluable,
Yeah, look, we don't want to turn every client, every investor into an expert, because not every investor wants to do that. I mean, all the people that around us are going to be investors for the rest of their lives. But what we want to give them is at least enough understanding, so when they hear the news on the drive to school or drive to work, and they hear that the US market's dropped or the gold price has gone up, or something catastrophic's happened, then they think, oh, okay, then I can relate that back to my portfolio, because the last investment update said that this is coming, or the election result, or whatever it might be, I knew this was coming. Okay, cool. And I'm not going to stress. Because people have enough stress and anxiety in their lives. They don't need to worry about, oh shit, my super's dropped by 4%. Or the market's dropping 4%. At least with the context that helps them just breathe.
All right.
And then understand that the portfolio. Won't follow. That understanding that the portfolio has been built because we expect volatility. We expect markets to go backwards. We've built a portfolio to withstand that stuff. So I think just having that understanding. Anyway, I'll shut up now and wrap up. I'll jump in and say, look, thanks for coming on, Nick. It's been great to have a chat with you, and it's been great working with you. So it's nice that we've been able to bring these solutions to our clients and bring them to life with your help. So thanks very much, and thanks for coming on for a chat.
Well, thanks for having me, guys. I really appreciate it.
Yeah, right. Beautiful.
Thanks so much, guys. Don't forget to subscribe to this on whatever platform you are listening to. Nick will be available basically a quarterly basis. The internal portfolios that we're running, we're super confident in terms of performance, in terms of the liquidity, and in terms of how it's going to perform over the long term. So if you'd like to get in touch, learn more, or if you are in the process of being invested, that's great. Ask some questions and we will go from there. Thanks so much, guys.
Beautiful. Thanks, guys. Cheers.